However, this week should be another really big one when it comes to interest rates. As the Fed's favorite measure of inflation, PCE, or personal consumption expenditures, price index will be reported for the month of June. Now, the expectations are that this metric likely fell in June, mirroring a trend seen in different inflation reports earlier this month. And if that result matches expectations, you could expect to see rates fall even further and give more confidence to the fact that the Fed will make its highly anticipated first rate cut in September. So keep an eye out for Friday. To all you real estate rainmakers out there, this is the Texas Real Estate and Finance Podcast market update for the week of July the 23rd. And I am your over-the-hill housing hero and host, Mike Mills, a North Texas mortgage banker with Geneva Financial. And I'm here each week to spill the tea on the latest real estate gossip and news. And today is no different. So interest rates are coming down and maybe coming down even more very soon. Thank you, sweet, tiny baby Jesus. Now, this is the great news that we've all been waiting for, but it might be at a cost. I'll tell you what that might be. After that, I'm going to tell you some good news related to housing affordability. And although headlines might be trying to tell you that a housing crash is imminent, it is very unlikely. But what is likely is a little relief for home buyers from these escalating prices. I'm going to tell you why a buyer's market might be coming our way sooner than you think, especially here in Texas. And if you're holding off on buying a house for now, but thinking about getting a car sometime soon, I'll tell you why the best time for that might just be right around the corner. I also have some big news for employees looking for a new job. I'll tell you why it might have just gotten much easier for you to make that employment change. I've also got a few thoughts to share on all the recent chaos around the presidential election that we've experienced over the last week. And finally, I'll discuss another underused loan program that could help your recent buyers get some relief on their high mortgage payments. It's just one more piece of knowledge for your real estate arsenal. So stick around to the end for that. However, before we get started, if you find today's episode helpful at all, then you can help me out in two ways. Number one, give me a little feedback on how you guys think we're doing here by liking, commenting, subscribing, or sharing this episode with a friend. Or number two, if you have a client who needs help navigating this increasingly difficult process of getting a mortgage, then send them our way. Both of these things help us further our cause to bringing you these episodes each and every week. And of course, are always appreciated. So share the love, help a guy out. Okay, first out of the gate today, as always, hey, Mike, what are the rates? Well, according to Mortgage News Daily, as of July 23rd, 2024, the average 30-year fixed conventional mortgage rate is about 6.87%. The average FHA 30-year rate is about 6.33%. The average 30-year VA rate is about 6.35%. The average 15-year conventional rate is about 6.32%. And the average jumbo rate is around 7.05%. So after a good week last week, rates finally got below 7% on average for the first time since April of this year. There was a small pullback in the bond market, causing rates to go up just slightly on Monday, but this kind of rebound is pretty common after consecutive days of improvement. However, this week should be another really big one when it comes to interest rates. As the Fed's favorite measure of inflation, PCE, or personal consumption expenditures, price index will be reported for the month of June. Now, the expectations are that this metric likely fell in June, mirroring a trend seen in different inflation reports earlier this month. And if that result matches expectations, you could expect to see rates fall even further and give more confidence to the fact that the Fed will make its highly anticipated first rate cut in September. So keep an eye out for Friday. Now, we've all been waiting for rates to start that decline downward since the middle of 2022. We're already 2 years into this higher rate environment thing, much longer than most, including myself, anticipated. But here we are. So with inflation starting to show real signs of falling, and maybe even more than reported, and the job market continuing to really struggle, with all of this, it's the perfect recipe for rates starting to come down. In fact, last week, new job listings declined over 12% from this time last year to their lowest levels since April of 2021. And overall, U.S. job postings are down 50% since their December of 2021 record openings. Part-time jobs are up, but full-time jobs are down. In fact, in June of 2024, the number of full-time workers fell by 38,000. While the number of part-time workers increased by 50,000. And according to Bloomberg, the total jobs in 2023 were likely overstated by 730,000. And all of this is just further indications that this economy is not strong and most likely started its real decline back in October of 2023. It's just going to take time for these numbers to bear themselves out when all the estimates get cleared out by actual data. And that takes months and months to aggregate. So if you want low rates, it looks like they are coming. How low, though, remains to be seen. It really just depends on how bad things get. However, just know this, historically speaking, when the Fed starts cutting rates, that time is typically when the economy gets to its worst place. So rates may come down, but historically speaking, that is not good for the overall economy. So as always, we got to be careful what we wish for here. All right. Right now is kind of a weird spot for housing. So I've been saying for a year or so now that you shouldn't see a significant shift down in home prices until we start climbing out of this 5-year inventory hole that we've been in. Well, based on recent data, it looks like that might start to be happening. Now, I've got some numbers I want to share with you for the nation, but also here for Texas specifically, because recently here in the Lone Star State, we've seen some big jump in inventory over the last couple months. But I do want you to keep a couple things in mind. Number one, this time of year is when we do typically start to see inventory increase. So having a jump in inventory as we head out of the summer is not very unusual. Number two, a lot of this available inventory is coming from new construction homes, many of which were set in motion to be built 8 to 12 months ago and are now coming online available for purchase. Number three, many of these builders that have this excess inventory have dramatically cut back their new permits and starts going forward, at least until they start to see a dramatic change in rates and people getting back into the desire to buy, because they still remember 2008 also and have no desires to repeat the mistake of having a huge burst in new home inventory like they did then. And right now, the current months of supply of new home inventory is about 9.3 months. But that includes homes that aren't fully ready to move in yet, because according to the National Association of Home Builders, only 21% of that number are homes that are actually ready to be moved into. That's about 100,000. So keep all this in mind when we're considering some of these national numbers. And the last thing to keep in mind is that we are at historic lows when it comes to buyers active in the market and submitting applications. So all of this goes into the effect of these housing numbers. So nationally last week, we actually saw a pretty big jump in inventory. According to Mike Simonson from Altos Research, inventory jumped 2.6% this week to 668,000 single-family homes unsold on the market. Now, that's 16,000 more homes compared to this time last week, and the biggest one-week change this year, but also less of a jump than what was happening this time last year. Because again, this is the time of year when we typically see these spikes in inventory. And although we have seen rates slip below 7% in many cases, that's still not enough to get many home buyers back heavier into the market to start eating up some of this additional inventory. Now, Simonson also states that this week we saw 69,000 new single family listings unsold, and that's 8% more than a year ago. There were another 15,000 new listings that were already under contract, which is very low for immediate sales recently. But remember, last year was characterized by an extreme shortage of sellers, and we only have 3% more sellers total this week than this time last year. So the growth is still small. Now, while unsold inventory is climbing, it's more from a lack of demand than it is from a massive supply surge. And Simonson does note that we've had a surprisingly strong economy for the last 2 years. And if that does change, which in my opinion, it's going to, and maybe more dramatically than I had originally predicted, then at least from his point of view, we could break out of this lower listing pattern. Right now, the median home price is around $450,000, which is unchanged from last week and unchanged from a year ago. But 38.6% of homes this week took a price cut, and that is up a little bit from last week. So all this means is that right now, prices aren't crashing, they're just kind of flattening out. We've already seen most of the appreciation that we're probably going to see this year, and the expectation for the rest of the year is that price appreciation is expected to be somewhere between 0 to 2%. Now, the bigger stat to watch is the pending sales numbers. These are homes that are currently under contract. Right now, there's only about 62,000 new pending contracts this week for single-family homes, and that's 9% fewer sales started this week than a year ago. And while mortgage applications did jump up a little bit last week because of the decline in rates, we are still at the lowest levels that we've seen since 1993. Yes, that's right. We have the lowest amount of mortgage applications that we've seen in almost 30 years. That's crazy. So the market is cooling and inventory is growing, but mostly due to the fact that fewer and fewer home buyers are willing to take the plunge with these high rates, high prices, high insurance, and high taxes. But the more inventory added could cause some of these prices to come down some. And with possibly lower rates by this time next year, that could also help out massively with affordability. It's just going to be a matter of how much inventory we actually have available when the rates do actually start to come down. Because if inventory is still constrained, then when rates do dramatically fall, you could expect to see prices jumping. So we'll just have to keep an eye out for that. Okay, now what about Texas? Well, the inventory picture gets a little bigger here in Texas, as all things do. So according to a second quarter report from 2024 from the Texas Realtors Association, the number of active listings from April to June were up almost 41% compared to the same period last year. Now, months of supply, which measures how many months the current supply would take to run out given the pace of sales, also increased. It grew from 3.1 months in the second quarter of 2023 to 4.6 months in the second quarter of 2024. And this is the highest amount of supply in the state that we've had in almost 8 years. But despite the rise in supply, the statewide median home price showed nearly flat growth, raising just under 1% year over year to $345,000. However, sales were down 3% compared to the second quarter of 2023, falling to just over $93,000 in sales. Now, this trend does vary depending on different metro areas in Texas. In Dallas, for example, Active listings were up 44%, pushing the months of supply to 3.8. Houston inventory was up about 43%, and months of supply grew to 4.2. San Antonio listings jumped 43.4%, bringing their months of supply to a little over 5. Now, Austin, on the other hand, has experienced a little bit less of a jump in active listings, with about 30% annualized increase and about a 4.8 month of supply at the end of the second quarter of 2024. But the housing market in Austin has been cooling quite a bit since all the flurry of activity that occurred in 2021 and 2022, whereas other major areas in Texas have been a little more stable. Now, cities in South Texas and along the Gulf Coast are showing elevated levels of months of supply relative to other parts of Texas as well, with Beaumont at 5.2, Brownsville at 7.2, Corpus Christi at 7.1, and McAllen at 6.8, each outpacing other statewide numbers. While markets in more remote areas, particularly in West Texas, are substantially different than the rest of Texas. Median home prices in Odessa were up almost 12%, Abilene was up 11%, San Angelo was up almost 9%, and Midland was up 6%. And supply in Odessa grew by a relatively modest 14.8%, bringing their months of supply right around 2.1. So in big metro areas in Texas, it is cooling off as far as demand, which again would be expected since it was one of the hottest states that people were looking to move to during and after COVID. So what comes up must come down. That's how this stuff works. And with lack of buyer demand, because of the high rates, it's fueling higher inventory just like everywhere else in the country. But all that means is that there are deals to be had if you are just looking in the right spots. Texas is on its way to becoming a buyer's market instead of a seller's market. So let your buyers know. All right, speaking of buying, are you thinking about buying a car sometime soon? Well, since I'm a mortgage professional, I have to make sure that you don't do it when you're in the process of buying a home. You really wouldn't actually believe how often that occurs. But aside from that, this fall will most likely be one of the best times to buy a used car that we've seen in quite a while. So the average used car was listed for about $25,251 in June. And that's down about $400 from May's price and more than $1,700 from last June. And truck prices overall are now down 17.5% since their peak in 2021. And that's the largest decline that we've seen in 15 years. In fact, over the last 35 years, there were only 2 times when prices of used vehicles saw a bigger drawdown, in 2004 and 2009. And overall, U.S. wholesale prices for used vehicles have declined for 22 consecutive months, with EV makers being hit the hardest, having some prices fall over 40% since last year. But remember, interest rates on these cars still remain high, which still makes it harder to qualify for a loan on these cars. Now, new vehicle prices have mostly held steady despite the drop in used cars. The average new car buyer in June paid about $48,644, which is just about $266 more than it was in May, and only about $307 lower than in June of 2023. But as many of you know, car insurance premiums have also spiked up. So high rates, but most likely declining, higher insurance, but mostly on newer cars, but lower car prices. So when should you look to buy? Well, typically from October through January 1st, dealerships are trying to meet their yearly quotas and may offer big discounts and incentives during that time. And December is often considered the cheapest month to buy a car, but you might have fewer options to choose from as their inventory starts to decline. Also, end of the month and end of the quarter are good times to buy. Similarly to the end of the year, dealerships may have sales goals that they need to meet at the end of each month or quarter, like March, June, September, and December. And holidays like Labor Day or Memorial Day might also be good times to buy a car. You may also have auto dealers giving good deals on Black Friday. So overall, cars are still expensive, but they are the cheapest that they've been in quite a while. And oh, by the way, if you can pay cash for a used car and not have to finance it and just carry liability insurance because you don't have a loan on it, then the end of this year might be a really excellent time for your next car purchase if you're in the market. So keep an eye out for those deals. Okay, with the economy starting to turn down and jobs not at the plenty right now, there has been a recent change to a long-held policy that restricted workers from making changes to employment based on their current employer's rules. But that just came to an end. So are you familiar with non-competes? Well, if not, a non-compete is a contract between employers and employees that restricts employees from working for competitors or starting a competing business within a certain time frame and geographic area after leaving the company. So the original idea was to protect employers' business interests, such as trade secrets, client lists, and other proprietary information. And typically these non-competes would often range from 6 months to 2 years after leaving your previous employer if you sign. However, recently the Federal Trade Commission, or the FTC, proposed a rule to ban these non-compete clauses for most employees across the United States. This move aims to make it easier for workers to change jobs and increase competition in the labor market. So why is this a big win for the employee? Well, first off, it gives increased job mobility. You can switch jobs within your profession much easier, leading to better opportunity and higher wages. It enhances the competition between employers. You see, companies must compete more aggressively to attract and retain talent, which can lead to improved working conditions and innovation. It also makes for fairer employment practices. You see, many non-competes have been criticized for being unfair, especially when imposed on low-wage workers who have little access to sensitive information anyway. And limiting these agreements helps protect workers from being unduly restricted. And really, it's been argued that these will help economic growth, because when workers can move freely between jobs, they can contribute to a more dynamic and robust economy. Companies overall benefit from a larger talent pool, and employees can use their skills where they're most needed, driving up overall productivity. However, as is the case in many situations of businesses versus employees, an injunction was filed in a Pennsylvania court that would block the rule put into place on April the 23rd. However, today it was announced that the injunction was denied. And as of right now, all non-compete agreements with employers will be banned and voided beginning September the 4th. So if you had to sign one of these and it's limited your upward mobility in your industry, then you are free at last. So get that resume ready. All right, I'm not going to go deep into all the stuff with the presidential election because it really doesn't directly relate to what we typically talk about here. Now, depending on who ultimately does get elected, it will impact us, but that is another discussion for another day. So as everyone knows by now, there was an assassination attempt on Trump on July the 13th. And right now there's a ton of controversy around how and why it happened, with the Secret Service at the center of this controversy. And on Sunday, Biden officially bowed out of the race for his second term as president, with Kamala Harris, at least for now, being the presumptive Democratic nominee. Except no one really voted for her to be, but no one was really allowed to run against Biden in the primary process anyway. So I guess that's just kind of how Democrats do it now. They just kind of let you know who they're going to nominate, and if you're a Democrat, you just kind of have to jump on board, I guess. But regardless of that, I do think things might get a little crazier between now and November. Because as you can tell from the national media coverage, no one with money or power in this current system wants Trump to win, except I guess maybe Elon Musk. But otherwise, the powers that be, whoever that is, certainly don't want Trump running this thing. At least that's how it appears. Right now, I don't think there's many out there that feel like Kamala can beat him anyway. So I do think there are still more moves to be played here. What they are, I have no idea. But what I do know is that this economy that we're living in right now is not as strong as we keep hearing about in the corporate media. And if Trump does win, which at least for now it appears like he will, then my guess is right after that, you're going to start to hear how bad things really are with jobs, GDP, spending, and corporate balance sheets. And at that time is when we might actually start to see things really start to take a bigger turn for the worse, at least as far as the economy is concerned. Because once they do admit that it's all in the toilet and then hand it all over to Trump for him to try to figure out how to make it all work and ultimately just say it's his problem and his economy going forward, that's when I think we may start to see some big turns down. Look, we're living in some really, really weird times right now. And maybe every generation has experienced stuff like this, and it just seems more intense because like I'm an adult living through it right now. But I really can't remember any time where things have seemed to be in this much turmoil. My hope is that we can just make it to the other side of this relatively unscathed, because we've done it before and I am sure that we can do it again. At least that is my hope, and that is what I'm going to continue to believe. So here's the stability and sanity for the rest of 2024. And that's all I have to say about that. All right. And finally for today, our main story. So there is a simple low-cost option for your clients who recently purchased a home using an FHA, VA, or USDA loan. And in most cases, it doesn't even require that they get an appraisal or even qualify with their income again. These magic loans are called Streamline Refinances. And I'm going to tell you how they work and how you or your clients can qualify for them. Now, recently on the show, I've been talking a lot about different types of refinance loans available to consumers. And most of you guys out there listening are realtors. And you might ask yourself, Mike, why should I care about this? Well, number one, it might apply to you if you have one of these types of loans. But more importantly, your goal as a realtor should be to have a little bit of knowledge and information about anything related to real estate. You should know a little bit about insurance. You should know a little bit about roofing, a little bit about title, et cetera, et cetera, et cetera. Because you need things to post on your social media sites on a regular basis to make sure that you stay in front of your clients as often as possible. And when your friends, family, and past clients give you a call to ask you questions, you want to have some answers. You don't have to be an expert, but the more information you can give, the more that they will always think of you when it comes time to buy or sell their next home. Because after all, you are their real estate Yoda. All right, so what is a Streamline Refinance? Well, a Streamline Refinance is a simplified refinancing option available to homeowners with existing government-backed mortgages such as FHA, USDA, and VA. It aims to lower monthly mortgage payments or change the loan terms with less hassle and fewer requirements compared to traditional refinancing. So how are the requirements less? Well, one of the biggest perks is reduced documentation, because the need for income and asset documentation in most cases is not required. Next, in most cases, the borrower will not need to get another appraisal. And this makes the process much faster and cheaper. Now, there are some cases with a Streamline Refinance where an appraisal is required, but I'm gonna touch on that in just a moment. And of course, having a cheaper refinance is always nice, because in many cases, you can do a Streamline Refinance and not bring hardly any funds to closing or even not have costs rolled into your loan at all. So you can literally do a refinance in this case with no income or asset documentation, no appraisal, and no costs at all. So that's a free refinance, right? Well, yes and no. Look, nothing ever is free. No bank is ever going to do free refinance for you. They may tell you that, but it's not the truth. Anytime you refinance, there's going to be title costs, recording charges, credit reporting fees, etc. However, in some cases, the lender can offer you a slightly higher rate than you otherwise would get and cover the costs for you. So you're paying more in your interest rate than you could if you covered the cost yourself. But sometimes if the rate difference is low enough and it doesn't cost you anything to do the loan, it still might make very good sense. It really just comes down to the math. Now, if you want to get the lowest rate that you can get in this type of refinance and the costs involved you feel are worth it to get that lower rate for the term of your loan, you have two options. If you don't want to get an appraisal, and there are many reasons why you may not want to do this, maybe the house hasn't appreciated much since you bought it, or maybe you bought a new build and got a ton of incentives and the appraised value just wouldn't get you to where you needed it to be, then you can just bring these costs out of pocket to closing and pay them without increasing your loan balance. However, if you feel that your home would appraise enough to allow your costs to be added to your loan, then you can just pay for the appraisal and have those costs added with no problem. And when I've done a lot of these in the past, I often would suggest to go the appraisal route because it made it possible to add the cost to the loan, allowing for nothing out of pocket and for the lowest rate possible. But if we're in a declining rate market, which we kind of are right now, and maybe for the foreseeable future, it's possible you could lower your rate just half a point and not have to come out of pocket at all or add any cost to your loan. And in that case, you're knowing that rates may still come down more in the coming months or years and have it make sense to refinance again. And in that case, doing the no appraisal route could make more sense because even though your rate is slightly higher than you would get if you had the cost rolled in, you aren't adding any additional cost to your loan. That allows you to plan on refinancing again sometime in the near future without continually adding cost to your loan every time you do this. So it really just depends on the circumstance. Now, who can do these streamlined refinances? Well, anyone with an FHA, USDA, or VA loan. These are called interest rate reduction loans for VA or IRRRLs. And as long as they're current on their mortgage and haven't had a 30-day late payment in the last 12 months, then they would be eligible. And a reminder again, you don't have to do these refinances with your current servicing bank. Any lender can do these for you. Now, if you have a conventional loan or got behind on payments in the last year, then you would not be eligible for this type of refinance. You also cannot access any equity with these loans. You can only reduce your rate and your payment. And in most cases, if you want to add to or even sometimes shorten your term for the loan that you have currently, then you may have to go the appraisal route regardless. Again, it just depends on what type of loan you have and what you're planning on doing. So Streamline Refinances can be a great option for a low cost, low hassle refinance to help your home buyers who purchased in the last couple of years bring down those high monthly mortgage payments. And just know this, as rates start to come down, and they look very likely to do this in the coming months, your clients will be calling you and asking if now is a good time to refinance. And that gives you the opportunity to start asking questions. Why are they wanting to refinance? How's the house coming along? How are you liking the neighborhood? You never know where these conversations can lead because it could actually lead to them wanting to move. Or because you're so knowledgeable about all things related to real estate, they're now sending you their best friend who is also looking to buy their house. You see, conversations about real estate lead to transactions. So the more conversations you have, the more transactions you're going to do. And if you're looking to find out more about these types of loans, give me a call. I'm happy to help. And now you know. Well, my friends, that is a wrap for today's episode. I hope each one of you have the great rest of your week and join me back here again next week to keep on keeping on, even through all this chaos. On Thursday, I'm going to welcome Dan Habib from MBS Highway to the show. Dan and I will go deep on mortgage rates and what to expect the rest of this year and into next. He's a wealth of knowledge on this stuff, and I get a lot of my content from their show. So this is one episode you don't want to miss. But until next time, be great humans and keep grinding because life is what you make it. So make it great. Take care.